Loading now, and we are live. Welcome, everybody. Live podcast recording here. Treasury Masterminds. We're live on LinkedIn. I'm really pleased with this speaker, this topic. It's a bit of a gamble, edgy, different. We're going to talk climate risk and the relation to Treasury. You would say there is none, but there definitely is, and we'll dive into this one. So, Marcus Cree, risk management specialist for market, credit, liquidity, and climate-related financial risk. I had to write that down because the list was quite long. Does it even fit on a card, Marcus? I don't know. So we're live on LinkedIn. That means listeners can ask questions. They will be popping up in the chat. You can use the comment section on the live on LinkedIn. Also to put comments out there, doesn't have to be questions. Make this interactive. Let us know where you're from. Let us know your concerns, your comments. We will read them, and I will pop them into Marcus as well. So let's dive straight into it. Marcus, our audience is treasurers here. Most treasurers will probably put climate risk somewhere between board diversity updates, new sustainable reporting on their to-do list, which is not very high. You would argue it's actually a financial risk issue. So my first question is, why should treasurers care?
And actually, it's a really good question. And in many ways, if you look forward in an ultra short-term way, then climate change, almost by definition, because it's a change in the probability of things, would seem to be less of a concern. But more and more treasurers, and risk managers I work with are looking at additional costs, which are starting to come in now. Things like insurance costs, things like credit risk, things like how do you price in the cost of something that is more likely to happen in the future? And in that sense, we start to discount backwards from an increased likelihood and increased loss in the future, and how that backs into decisions we make now and what we charge now for almost anything we do. And in particular, things like, in its most immediate form, 90% of the clients I work with at the moment are most concerned with making decisions with increasing insurance costs attached to them, and that has a very immediate effect on what actually goes on, because that's actually being determined about some future increase in probability, as opposed to something which is happening right now outside the window.
Interesting. But then most treasurers have a treasury policy, a risk framework, so to say, and there's already market risk, credit risk, liquidity risk, FIS risk, interest rate risk on it. So how do we fit climate risk in there?
I think it's probably most likely that it never becomes a standalone topic.
Okay.
And for this, I think we can take some guidance, some instruction, if you like, from the way the Basel Committee for the banking, for the banking community, how they structured their climate guidance. Now, unlike most things that organization does, it's less prescriptive in terms of exact numbers of how things get calculated. But what it is 12 principled guidance, and it actually covers market, credit, and liquidity, and how much you reflect the climate risk in those things. Now, this becomes, you could think that was just a relatively small adjustment if you wanted to, but actually it's an interesting space, because it's a new dimension of what can happen in those spaces, and if trying to reflect what happens to your liquidity and credit in particular requires some dimensional thinking about what happens in the world in terms of emissions, in terms of mitigation, in terms of adaptation. And so you have multiple pathways. So you get almost a fourth dimensional kind of breakout, which gives you a whole new distribution of what can happen for each one. So it's not market, climate, liquidity, and it's not market, liquidity, credit, and climate. It's more climate within market, climate within credit, and climate within liquidity.
Yeah, it's a good point. It's a good point. So let's make this concrete. So flooding, heat stress, hurricanes, whatever. How do we translate that into real financial exposures? And maybe combine it with the next question. What examples of climate events have directly affected my cash forecast and liquidity?
Okay, so let's think about some, like you say, concrete examples. I'm actually based in New York, in the US. And if I think about the last couple of years in this country, certainly this year we've had a very light hurricane season. But last year we had an extremely heavy hurricane season on the East Coast. On the West Coast, we had a very bad wildfire season. And there was an awful lot of hail and tornado activity in the middle of the country. So all in all, we have to look at kind of a business loss days, as well as the impact those things have on, as I said earlier, those insurance rates. You mentioned flooding. So, I mean, that's on our, let's call what I've just said a macro view. On a micro view, there are reasonably well reported instances of flooding in Germany, river-based flooding in Germany, flooding manufacturing of doors, which then feeds through to an extremely well-known car maker being late and taking a share price hit in the same year, because whilst it itself was not impacted, it was picking up doors from that particular flooded place. So one way of looking at this is, when we think about climate, think about the whole of a business. Now, this can be a business that we're running, a business we're financing, but that business has a deep supply chain. And the world's moved to a just-in-time basis a long time ago. So all of a sudden, an increasing probability of something happening means more days are going to be lost. There is a higher chance of something not being reached, and that will break down the whole supply chain. And that's, think about if you've got goods coming through ports, and those ports get knocked out. And if we want to see the impact of what a port has on our short and midterm financing, a couple of years ago, somebody parked sideways in the Suez Canal, and the world's supply chains were disrupted for months after. So you could say these small events are just that, but we could equally say that a port being out for an extent more than an expected number of days per year has a disproportionately large impact on supply chains, and therefore all of those payment systems and payment processes that go along with that supply chain and business. And what does that do to your financing and to how you the downstream of those goods that you're not receiving at that time? We're not even touching on things going bad and things being time sensitive. Just in simple terms of the timing of the supply chain, is the impact's bad enough, and we can layer on top of that what can happen thereafter. That becomes a now problem rather than a theoretical problem.
Yeah, makes sense. The black swan events, really, yeah. But then again, many treasurers use value at risk models, VAR models, which are often quite short. But how do we integrate climate risk variables into our value at risk models? Are there probabilities available? Are there numbers available?
Well, market risk, I think I mentioned earlier, market risk is probably the least impacted of all of them, for the simple reason of how many days forward a value at risk model looks. So you are really talking about market rates. Now, you could argue that market rates become more volatile in that situation. And so therefore you might want to increase the volatility component of how you calculate those VARs. I would say it's disruptive in a subtle way on VAR, and a less subtle but bigger way on things like credit VAR, things like long-term potential future exposures on the credit side, because you can imagine that the credit side becomes much more impacted, because we have to start to incorporate those future climate incidences which come as a result of climate change. So climate change increases the probability and the magnitude. That means those future costs and that future impact on the cash flow of our counterpart in these things, our customer or whoever it is, that now has to be reflected in today. We have to back into that somehow. We have to say, okay, you're a higher risk, so we are doing like a forward on the credit risk, if you like, and that has to be properly priced in now. Otherwise, we are simply not taking into account the real risk of the situation. That being the case, there is the chance of sudden kind of shocks going through. So probably you can best liken it to, does the VAR, is a short-term VAR on the market risk side now, is a short-term VAR impacted by, say, a tariff policy? So if tariffs can come tomorrow, if we think there is a higher chance of tariffs, have we somehow decoupled what used to be the correlations we relied on? Because if we have, and if that has that impact, then climate's more or less the same thing. It's just that we've introduced a dice roll into where it comes from, but the impact's very similar. So we have to start questioning, can we always use our past correlations and our histories to go forward if we are making some areas much more liable to disruption than others, and therefore changing the kind of risk components of some places over others in really quite a disproportionate manner. Now you can see on the credit side, it's far easier to see how that works. If I have a supplier where 90% of their supply chain is in areas which are going to be increasingly disrupted, they have to be a higher credit risk. Mm-hmm. Because their cash flow is going to be more impacted. Their insurance costs are going to increase by a greater amount. That's, I think, clearly fairly easy to see. But then thinking about what that does to the correlations and potentially how it reorders the market shape, I can't tell you necessarily how to fix it in market risk, but I can tell you there's a problem emerging within it.
Mm-hmm. Mm-hmm. But it does mean that in the preparation you told me about your FIS climate risk modeler, which you offer to clients, and that's a 100-year prediction in 5-year periods going forward. If I translate that back to treasurers, we think in 13-week forecasts, in quarters, not even up to a year. So how does that fit together?
The treasurer in this situation wouldn't be looking at the 2075 estimate of the number of hurricanes. That's going to be completely irrelevant. But if we chunk that down into components that would be useful, on the one hand, given that anyone who's looking at our like you say, our climate risk modeler, the first thing they would look at is that century prediction, because you would expect to see a hockey stick in the graph. If you don't see some kind of a hockey stick, so that the build-up over the short term suddenly, as it reaches a kind of a critical mass and spikes upwards, then there's probably something wrong with the model. So you do need that long-term in. But when you come to sensible project financing, we would start to look really 25, 30 years would be the outside. 25 years is not that abnormal. And why? And why does this start to impact the players? Well, if you think that any given project or situation can have, in a very simple form, three players in it. You've got the customer, the financer, and the insurer. Well, both the customer and the financer have an interest of an ROI that extends past the short term. So they're making strategic decisions, project-based decisions, if you like, which can be 15, 25 years to reach full ROI and gain value and traction. The financer, the bank in most cases, will be equally looking over that time frame as the finance partner. The insurer only has to look 1 year. And so each year they have that withdrawal choice. Now they would say that's not necessarily what they want to do, and it's true that it's not, but it is how that risk breaks down. So I could start to have uninsured assets. I could not. We're starting to see this. Canada its rate of climate change is higher than most of the rest of the world. You're seeing it in parts of Africa, parts of Asia, where if you are exposed to those, you simply have to kind of compress down the future impact, because it drastically reduces the time frame for an ROI to be realized, and creates much more likelihood of stranded assets, uninsured and usable assets, which then start to impact my short term as I do business and make these decisions, and other people do business with me on the basis of what they're expecting to be a longer term partnership and financial situation. So again, everything comes down to, I might only look 13 weeks forward, but the factors going into that 13 weeks, everything I'm discounting, all the financial instruments that I price on my in my book, they are discounting forward many forward quarters to give me the price offer. I don't just look at my payments in and out for the next two and say, okay, that's the price of this particular derivative. I price the derivative against that curve. That curve is being changed by external factors, and those external factors, in this case, are climate change. And what something like our modeler does, and what anyone ought to do, is be looking at a low emission path, i.e., the world does what it says it was going to do 30 years ago, and we go to a low emission pathway. Or it looks at a mid emission. That, by the way, would keep heating to 1.5 degrees by the end of the century, maybe 2 degrees, but it would be manageable. If we go to a mid pathway, these are the UN type pathways as they project them forward, the things that take 4 or 5 years to create. The mid pathway would see more heating in the end, generally front stacked, and so it levels out to what's referred to as net zero. It levels out to that a little bit later, so it's stacked in that front end, gets us to 3.5 degrees, something like that by the end of the century. That's quite a significant difference in terms of the impacts, but still manageable. We could use that as a halfway house and just say, best will in the world, we'll slice it down the middle and use that. Or we could use what's called the hothouse world, which is where we do very little of anything to actually curtail CO2 or its equivalents. We leave it too late to start to do anything, and all the money that we could use to reduce goes to adaptation, in which case literally nothing is done to reduce the CO2. And then we get up to the 5-6 degrees, which takes some parts of the world to catastrophic levels. And if that happens, you do get to the middle of the century, the end of projects we are now in. Remember, we're at the end of 2025. Someone buying a house now in most places in the world will be paying a mortgage past 2050. So, just as a bit of kind of context, when we think about that, and when those impacts start to make that asset worthless, at what point does that asset become an asset that's going to be impacted? It might get wiped out in 75. Then it will be worthless in 2060, 50. Before that, it's like leasehold and freehold. All these problems that we've seen in other areas, if you're a leaseholder rather than a freeholder, you have a different, in England anyway, that has a massive impact on the what something's worth. So we have to look at what the model's telling us and say, when will that impact start to really materially deteriorate the ongoing value of the asset or being financed or the project? And then it very rapidly discounts into today's cash window.
Yeah, so it means it will optimize my my insurance premium going forward, if I have to insure my risk, or the premium I'm paying. In the example of the mortgage, which is also relevant for a treasurer, because we do, of course, we do bank financing, probably not for the whole 25 years. No bank will ever give me that, but I'll do 3 to 7 years, and I assume I roll over with the same credit spread. But if my credit spread goes up because my bank uses this model, and they think, okay, the flooding risk is higher, the hurricane risk, or whatever risk, climate-related risk, then they factor that into account. So they already offer me a higher premium now because that's discounted in. So I should use that as a treasurer as well. That's basically what you're saying, right? Very interesting. Yeah. Okay. Even more tasks on our to-do list for treasury teams, and then also looking at the regulation aspect. We have IFRS, CSRD, Basel 2 and 3. We have disclosure rules coming up, especially on the financial risk side. That's often, I don't want to say dumped with treasury teams, but that's the new reality coming up. Is this something we are going to have to deal with? Probably, right?
Absolutely. And the physical risk, in many ways, it's the most detail laden, but it's also the easiest to conceptualize, because it's physics. In the end, it's a mix of physics and probability. So there are potential costs which go in all those things we've discussed. Everything you just kind of nicely put together in terms of those future costs, and that's discounted into now. I can put a number on what that increasing risk to supply chains, to my business, to my physical properties are. And that's a significant part of the reporting. The transition risk is actually a little harder, because the transition risk depends on what in the end I have to do and where my start point is. So it's less easy for me to say, okay, your transition risk will be that you have to cut your CO2, or maybe you don't. Maybe they go to carbon trading. Maybe they have a carbon tax. Maybe there's exemptions. So far, nothing has really come in which has cost a lot of money to actually do any of this stuff. The border carbon agreements, they're talked about, they're not really in place yet. There isn't a meaningfully low and penal carbon tax scheme in operation, or the carbon credit costs. So the one thing I can look at is how my assets will be degraded. Because yes, the insurance might go up, but more importantly, if the insurance goes up past a certain point, the asset itself becomes worthless. If someone else can't insure it, now this is a thing that's becoming talked about in certain previously, well, and now very high value areas in places like Florida, where the only property you end up being able to buy is one you can completely self-insure, which basically means no insurance and you can afford the loss. That's really what that statement means. And so you in a corporate sense, that doesn't work. I have to be able to insure my workers. You mentioned heat stress earlier. You know, we put heat stress on our workers as one of the outputs of our system because that really strands areas and assets. Because you are either going, if it's indoor and coolable, the cost becomes quite prohibitive. If it's not, then the cost is just completely negates the idea of working there. And it is massive. It's somewhere around 38 degrees, where if the heat goes up past that, the rate at which a worker's efficiency degrades becomes, you know, ever more acute. And so you will start to get huge losses in those areas with no capacity to realize any ongoing value from it. We thought that would happen with transition risk, with if you're forced to leave oil in the ground, then suddenly a lucrative and highly expensive oil field becomes a field, which you can't drill on. But that requires all that regulation going in and sticking. What doesn't require a kind of a viewpoint or a political decision is an increasing probability of extremely severe hurricanes will knock the capacity for any value to be realized from some coastal areas out completely, as will constant sea surge, sea rise, and such. That can be put in, and we have to start thinking at least about the frameworks in how we're going to explain these. Yeah, all those regulations you mentioned, they're great. It starts, but they're nowhere near an endpoint in my view. The kind of sophistication we're going to have to think about as we go down these pathways and we start to near critical mass points that will severely change what the ongoing trajectory thereafter is. I think it will become really quite interesting how we have to report this.
Yeah, but I do hear some treasurers thinking who are listening now, Marcus, it's all nice, it's all regulation, but I'm Treasury. I'm 2 to 4 people. I'm the smallest team here. This is not on me. Put it on the sustainability team, put it on the general risk team. Should this be with Treasury?
Arguably, you could say it should sit between risk and treasury. I think one of the reasons this falls between the gaps, if we see this purely a reporting concept, then someone in sustainability is responsible for filling out that particular report. But I see reporting as the last thing we do. And the first thing we do is have inbound and outbound risk. In my opinion, the sustainability team are looking at the outbound risk, i.e. what we do to the environment, the CO2 we emit, the CO2 we finance. However you want to express that as a risk, do we operate sustainably? The incoming risk has to sit with the financial risk people because there's nothing you can do as an organization to stop the general environment in which you operate. So that then has to be taken into account in the general risk team. So then you say, okay, which risk team should it be? But in the end, it all centers around Treasury, because it all starts to become about capital management, regardless of where that's being reported from. Now, it can be a market risk team. If I'm talking to a bank, the market risk team are generally the least interested, the credit risk team the most interested, then the liquidity, and then it kind of filters down into Treasury, because both those things go into sort of pricing and running a thing. If I'm talking to a corporate, like a non-banking corporate, then the conversation is going to be somewhere between facilities, risk insurance, Treasury, and they may or may not have a resiliency group. Each one of them has climate as a portion of what they do, and that will be an increasing portion generally, from 0 to now, and it's going to get higher. And again, that will circle around the Treasury, because it goes to budgeting, hardening budgets, managing assets. Well, all of that in the end runs on a day-to-day basis through Treasury. A mitigation effect that gets paid for now to mitigate in the future. Treasury have to know what's going on and driving these things, in my view. But it's generally a collaborative group. You are correct, very correct in saying.
No, it makes sense. But if you talk to a treasurer and you mention climate, sustainability, green, we immediately triggered by green bonds, green financing, green facilities. There's even now green supply chain finance currently. But is that the wrong approach then, to make my financing, what I already have in Treasury, make that green? But you're saying that's not enough. You should also look at it from a risk perspective and model that.
Yeah, I'm probably more jaded, to use a potentially unfortunate phrase, on things like the green bonds and the green financing, because a lot of that goes with the greenwashing, and there is certain premiums which have been generated in a way that isn't necessarily helpful. The reason the risk, I don't really call it green risk or green anything really. What it is an identifiable factor that impacts your risk management and ultimately cash management, and that factor is so large as to warrant being treated and pulled out and reported on independently. Let's put it that way. Because if I just say there's a climate related adjustment here on the credit, that requires a lot of unpacking. What's going into that assumption? I could stack someone's credit risk against them by assuming the worst possible emissions future, no strategy on their part, and back all of that into their risk now. Is that reasonable? Maybe if I do it with everything across the board. But what I also want to do is really think about, is there a break point with that client, with that partner, with that customer? Is there a point where if I'm on a low and mid path, they're okay, and it breaks at this path? Is it fair just to average those things? This is similar to when we think about jump to default and things of that nature. So there's some real thought that has to go into this, because it's going to impact my relationships with my customers, counterparts. It's going to impact my cash flow and where that goes, and my overall strategy. So that reason and the dimensional complexity of what needs to be at least kind of pulled into the conversation means it has to be treated as a specific factor. And again, I'm going to use, say, US tariffs as an example. Anyone doing their reporting this year who works internationally and where that business goes through the US will pull out as a part of their reporting the impact or otherwise of tariffs, because it's just too big just to be washed into it all and it just be taken as read that it's there. Well, think of climate more like that. It's not a new category, but it's an impacting category that is either big enough now or too big now, or is definitely going to be, just to be assumed to be within the watch. It has to be pulled out and has to be identified. And I think that's all the seeds of what the ECB are doing, all the accounting regs you mentioned. That's what they're starting to ask for. Are you pulling these threads of these particular things and making sure that stakeholders are aware of that, because that fact is too big just to be watched into the rest.
Mm-hmm. And what if I ignore that? I say, okay, you know what? I don't see it as a risk. It's too long term. I understand the tariffs that's in the news, but climate risk, it's in the news for the last 20 years. I ignore it. Is it only my reputation on the line, or are there bigger risks?
No, in fact, I personally believe there's very little reputational risk.
Okay.
And I think you could look at many examples that if reputational risk really existed, then some financial institutions, some oil companies, they simply wouldn't exist.
Fair point.
But I think in general, the economic imperative will overtake the reputational one. However, businesses being financed at too low rates and therefore being hit by events that should have been incorporated into those rates, that hits you financially, because it's a form of kind of financial mismanagement to ignore what you know or ought to know is going to have an impact on those probabilities. I remember when I was still in stockbroking in 1998, you could buy Russian bonds knowing there was going to be a default.
Yes.
But it was fine. And it generally was, because you were buying them at a rate that what you would get back in whatever dividends they were going to pay would be paying you the equivalent of buying a UK gilt or a US Treasury, because it was priced right. And I think that's the thing, and that's what treasurers and risk people know, which isn't always intuitive to other folks who are engaged in this part of the business. Any risk can be priced in. The question on climate is, what, if anything, are we pricing in? And how have we got there? And if we haven't thought about that question, then the chances are it's not being priced in, or someone else is pricing it in for us. And we are not understanding or controlling what's governing that. That doesn't seem to be in a position most treasurers or risk managers that I know or speak to or work with would want to be in to be there. So I think it's actually not a bad way of at least thinking about how that has to be.
Yeah, interesting. So there are probably some audience listeners here who think, Marcus, you have a great point here. I'm inspired. I'm not looking at climate risk yet. I need to start. I need to start working on this. I need to incorporate it in my treasury, in my forecasting, in my exposures. But then they are like, oh my God, I'm overwhelmed. Where do I start? How do I start doing this? Should we all reach out to you? What should we do?
Well, I mean, yeah, of course, you could reach out, of course, and I would very much encourage people to do so. I mean, it's such a vast topic. It does distill relatively down. I would suggest that whilst there are lots of things you can read and study, the single best place to start looking is get a hold of the Basel 12 principles. It's a very easy read. It's not mathematical in any way, but does a fairly good job of talking about and this is really from a banking perspective, but I think it translates pretty well across, because it does a fairly good job of explaining how this future risk has to be considered in these current risks, and how that impacts what stakeholders need to know and arguably have a right to know in terms of how those risks get priced in. banks in the end reflect economies. They work within and they reflect economies and what they do. And I think it's that particular document and it is just the 12 principles that need to be put in. I think it distills better than anything else in around about 10 pages, which is remarkably short. And at least that points you in the direction of where you ought to start thinking about where the impacts are. Now, from there, if anyone on LinkedIn wants to enroll in NYU, I do teach the green finance course down there, so they can always come along and learn it that way.
Definitely, very good one, very good one. Before I move to my final question, again, want to say to the audience, if you have questions to Marcus now, live, post them in the chat and we will see them and we will ask them now. Otherwise, you want to do it anonymously, that's all fine. Marcus is on LinkedIn. You can reach him or reach out to us for his email contact details and we share it with you and you can talk to Marcus directly. So the final question, Marcus, is on the collaboration. Treasury teams can never do this on their own. They're already struggling with the workload. They're usually small teams, 2 small teams from what I hear from my clients, from our community. Now this comes on top of them. I already heard you say it's a collaborative thing. It shouldn't be only on Treasury. We should work with the sustainability teams. We should maybe work together with the banks as well. So how should we do that? Should we just be talking to them on a bi-weekly basis? Agree who does what? Should we reach out to our banks? Is there one approach that would work best?
I think working with particularly, this is I think particularly more true in Europe at the moment. Certainly the most true. Actually, Africa is quite progressive in this area, but the banking approach is quite good. And I don't think this does not have to be a daily, weekly, bi-weekly task here. It has to be something which gets considered in the round. So I would say break down what it is and why you think it ought to matter. In the immediate future, I think the banking relationship is probably the best one to start with because they're going to reflect straight back that those potential additional costs. I would work with my insurance teams and see what's going on there, and I would work with any facilities team. And I'd say, what are you factoring in terms of ramp up of costs in various assets around the world or around our business? I would then look at our supply chain teams and say, where is this going to hit us? Now, somewhere in the middle of that, each one of those will have a portion of that. If I'm a corporate treasurer right now, it's going to be my finance teams. That's the guys who work with the bank. It's treasury, I guess. And then there's the supply chain and there's facilities. They're going to be my main go-to. And that's where I'm going to say, what are you likely to need? Now, at this point, all I want to know is that they are aware of it. I am not in charge of telling them the physics of climate change, but they are in charge of the facilities and putting together robust and working supply chain. So arguably, whilst it's going to reflect down onto what I do, it's going to start where they are. They're on the front line of that. And what I want them to know is I'm quite happy and would like to support that. And in the spirit of no surprises, I'd like to know what they're doing with that and work with them. And I think starting the conversation that way, because it gives you a kind of a rational and a hard start point as a business, which you as a treasury manager can be pre-planning for by working hand in hand with those. But I'd say facilities and supply chain and finance are probably the places where I'd want to be.
Yeah, makes total sense. I talked to a treasurer this morning and he said some treasurers are too much in their bubble doing their treasury thing, and not understanding the business, not talking enough to the business, and therefore not understanding the supply chain. It was about supply chain finance, the whole supply chain. So, and if you don't understand that, you can still run your treasury, but not in a way that covers these topics like future outlooks, risks, insurance premiums, and eventually it drills down to also the financing premiums you're paying with your bank. Because, like you say, your bank is probably going to project this 20, 30, 50-year climate risk as part of the market credit and liquidity risk on you from a bank perspective, and already telling you, okay, if your premium is going to 200 basis points in 10 years and you're paying 50 now, I might be increasing it to 100 already now, like you say, if you already go default, but if you are compensated enough for it right now, it's still fine. You're going default as long as the price is right, which that really triggered me from an outlook perspective. And I hope it's an eye opener for many listeners here, for treasurers to focus a bit more on the longer term. And yes, we are struggling. We have priorities for short-term cash flow forecasts, managing liquidity, cash pool, all short-term tasks. And we would say, okay, it's FP&A, it's risk who does the long term. But I think you inspired at least me, and I hope the audience as well, to also look at the longer term, to factor in this climate risk, and it's getting bigger and bigger. So thanks for being on the podcast, Marcus. I really learned some new things on this one, and that was also the whole goal of this podcast, to trigger our treasury community a bit on. It's not only about treasury. There are other risks involved which are going to impact you, which can be scary at the same time, but can also be an opportunity for treasury to go out there, learn something new, shift their focus. And I invite everybody to link to Marcus if you're interested to go deep dive. If you want to learn more about the FIS climate risk modeler, and I've seen pieces of it. It's quite impressive on the 100-year projections on climate, the 2-degree, 4-degree pathways, and the effects of it. It's quite impressive to see. Still hard for me to translate that into treasury, but yeah, that was the goal of this podcast. So if you want to learn more about this risk modeler, also reach out to Marcus. He can tell you everything about it, insurance premiums and everything. So thanks again, Marcus, for being on the podcast, for sharing your knowledge with our community. And yeah, let's keep in touch. And you will forever be on Spotify and YouTube with this one.
Thank you very much.
Thank you.
Bye.
So stream ended.